Good afternoon, ladies and gentlemen, and welcome to the STM Group results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via stm@walbrookpr.com. We will endeavour to answer all questions today. However, failing that, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. In a slight change to the running order today, we're going to update on a couple of the present issues, namely the Adams Gerry case and the background to the delay in announcing the results before we actually move into the results presentation itself. So I know that these will be two questions that people will have at the forefront, so we wanted to address those good and early. I'd like to hand you over to Chief Executive Alan Kentish and Chief Financial Officer Nicole Cole.
Thanks, Tom, and thanks IMC for hosting the STM Group investor presentation. As Tom says, clearly we're announcing our results around about 2.5 months later than we would normally. That really comes about as a result of the Supreme Court's decision not to allow appeal on the Gerry Adams case. For those that have been sort of following us and in fact following the pensions industry generally in the UK, they'll be aware that the Gerry Adams case is a precedent case as to what are the requirements for a SIP provider in terms of what services they provide and what potentially is their exposure in terms of liabilities. The Gerry Adams case, Mr. Adams, is a very specific, fact-specific scenario. And 3 or 4 days before we were due to announce our results, there was this ruling by the court. So what does that mean? In terms of Mr. Adams himself, it doesn't really mean a lot in terms of what we would potentially be required to pay over, albeit is covered by our PI insurance, and it's something that I'll reiterate again later on. So there's no financial impact, but the problem the auditors had really was, as a result of this ruling, is there any other people within our pension members, within our SIP business, that have the same facts, i.e. the same introduction pattern as to where Mr. Adams came from, and indeed what investments had he already made, had made into, and were there other members like-minded to invest in that? And that really resulted in an analysis of basically the SIP membership. What is the cohort that actually sits within that membership, and therefore what was the number in the balance sheet number that was needed to be provided on the balance sheet, and Nicole will cover that off. But to hasten to add that it has no financial impact in terms of our profit and loss, given our professional indemnity insurance. And hence, here we are today, 2.5 months later, having signed off the accounts yesterday. So hopefully that will cover off. I will explain a bit more about the Gerry Adams case and potentially what I think are the implications to the pension industry generally a little bit for later on. But let's get back to STM, because hopefully that's why we're all listening in. STM, basically, I would describe as the administrator of client assets. We used to be involved in the trust and company sector, but really now our pure focus is on retirement solutions. So it's to do with workplace pensions. That's the auto enrolment business in the UK. It's to do with UK personal pensions, such as self-invested personal pensions. It's to do with group pension plans and SASs, etc. Again, a UK product. But we've also got an international division, which really is evolved around what I would term an overseas SIP. So it's not a UK regulated product, but it's a product that's, for us, is regulated in Malta or Gibraltar, and that's the Curots. Those familiar with our business will see that it's a healthy, steady annuity stream in terms of that revenue side of things. Again, there's a slide on attrition rates, etc. further on. And then finally, in a very similar manner, our life assurance wrappers are pieces of portfolio bond business that's written out of Gibraltar. Again, the common theme for us as STM in terms of our risk profile is we don't give investment advice, we don't give tax advice, we don't take mortality risk. It's about the administration of assets. In a similar way, for instance, in terms of looking at UK peers, it might be someone like Curtis Banks, etc. So sort of putting a bit more sort of flesh on the bone as to where we're moving to, what are we focusing on? And we've got a number of different pillars that we see as absolute key to the success of STM. One of the things that I don't think we've done particularly well is that we have a whole range of products, probably more so than anyone else in the pension market to a certain degree. Probably makes it sound bigger than we are. But if you look at, for instance, a lot of SIP providers, they don't have a workplace pension. You look at a lot of the workplace pension providers, auto enrolment in the UK, they don't have a personal pension solution. They don't have an international solution in terms of personal pensions. And I think what we haven't done to date, or as successful as we could do, is join those dots. You know, we have the cliched phrase of cradle to grave in terms of that process. Someone out of university, getting their first job, therefore becoming an auto enrolment member, through to those individuals that become senior managers in their businesses, etc., employers who may rather opt out of the auto enrolment and use a SIP as their retirement vehicle going forward, through to, for instance, our flexible annuities for basically retirement and drawdown solutions. So a focus for us in terms of really getting more business really from our existing product range is just to look at that profile and really start to stitch it together. The other area where, again, because we've got this range of different in vehicles that can hold these pensions, is to look at some of these other niche products. You know, for instance, the Sharia product, we've partnered with Wahed Invest, which is a JP Morgan fintech company. You know, as the name says on the tin, they specialize in Sharia compliant products. So they've got a niche market there. In my view, not particularly well served by the general market as a whole in terms of that, but a very large niche to look for. Then you've got the complementary products where our employers within our UK auto enrolment business also have overseas subsidiaries. You know, do they want to offer similar pension solutions for their international colleagues? Quite possibly, and part of that is really us looking at launching things like our international occupational pensions. Moving on, the other core strategic pillar for us in terms of growth is acquisitions. And I think we have a reasonable track record in terms of what we've achieved. There is a slide that gives a bit more about the profile of things that we will look to acquire. Looking forward, we will continue to make acquisitions. We see that as an easy way of bolting up and giving our businesses scale. Focus primarily will be in the UK more than other areas. I guess the bit we can't ignore is, you know, our results in terms of margins compared to some of our peers is significantly below our peers. And one of our focuses has to be about improving that margin. The upside is that it's there for the taking. You know, there's on a business that's got 22 million in recurring revenue, then there's absolutely no reason we can't get that scalability. A lot of what 2021 was about was actually moving on to two specific platforms. One is for our corporate solutions business. One's for our personal pension solutions business. We're now on those platforms. Now we can start to look at basically getting those economies of scales and driving those efficiencies. And finally, it's also about ensuring that we provide a service that to our intermediaries and our customers that really is second to none, and we can actually ensure that we gain market share by investing in things like laptop technology, by working with strategic partners, a good example being Wahed Invest again, a fintech company that has got that technology platform to progress. So that's really that focus that really come through in 2021, but also into 2022. I guess one of the complexities of our business is, but also one of the opportunities of our business is the fact that we have 3 jurisdictions, clearly not nationally, but internationally. Gibraltar, Malta, which does our Cure Ops business and our international occupational and has the life companies, and our UK business, which has the corporate pension solution and the SIP business and the SaaS business. You'll see, give you a snapshot in terms of our size, 286 colleagues and circa 270,000 members. Again, that's broken down a bit more in terms of the detail further on. So where do we get to in terms of operational highlights for 2021? It feels like it's been a fairly tough year, and I think Nicole's only just coming out 2021, having finally got the audit signed off. But when you look at what we've achieved, it actually is fairly significant. We've moved our businesses onto these platforms. We've restructured in terms of that business development side of things. What we now need to see is ensure that that top line does grow to our expectations. For me, I felt that we didn't achieve as much revenue growth as I would have liked to have seen in the second half of 2021. We've got some very good strategic partners that we are aligned to, signed up with, and we need to ensure that we deliver our share of that proposition with our strategic partners as they do theirs. A lot of that is around communication between 2 IT systems, and that's frustratingly taken longer than I would have liked in terms of really getting volume coming through on it in terms of our strategic partners. And finally, we have launched our Australian superannuation solution. You can't ignore the fact that the Australian market for UK expats is very, very significant. Pretty insignificant in relation to the Australian superannuation for Australian nationals, but very significant as an expat market. And as a solution, we've got the ability to export UK pensions to Australia. That becomes quite important when you're about to take your pension in Australia, because if you take it from an Australian pension fund, then it's tax-free. If you take it from outside an Australian fund, then there's tax to be paid in Australia. So we believe that there's significant upside and optimism in finally getting this product launched. So I'll hand over now to Nicole to give you some numbers.
Thanks, Alan, and good afternoon, everyone. In terms of financial highlights, the results reflect, as Alan mentioned, the embedding of acquisitions of recent years, and the revenue is in line with forecast at 22.4 million. That reflects the sale of a non-core operation in the trust business, but equally growth in the pension business line by about 7% year on year, with the full year's impact of Berkeley Burke's acquisition included, as well as some significant organic growth, which I'll come on to in due course. There's steady revenues from the life assurance business line and other areas of the business. In terms of earnings before interest, tax and depreciation, EBITDA, 2.8 million for the year, which is slightly below forecast and reflects the cost base. In terms of profit before tax, 1.2 million for the year. However, there were a number of other items, which mean that reported profit before other items was actually 1.4 million. Interestingly, profit after tax was 1.7 million, a marginal increase year on year, and reflects a one-off tax credit that was recognised at the end of 2021. In terms of positive news, dividend growth year on year, as well as positive cash balances, rendered the business in a strong position to focus now on delivering the margin growth and operational efficiencies that Alan alluded to through the optimization of the target operating model with further investment in systems and people. Moving on to the next slide, in terms of looking in more detail at the revenue contribution, you note a notable increase in the revenue contribution from pensions, which is aligned to the more UK focus of the business, as well as already mentioned the full year impact of the Berkeley Burke acquisition, but most notably a 49% increase in the auto enrolment revenues, as well as a doubling of the group personal pension plan revenues, which we'll see in due course. I think most notably, Alan already mentioned in the highlights the strong recurring revenues, and certainly when one looks at the revenue broken down on a quarterly basis, consistent, steady revenues across all business lines are evident. Moving on specifically to an analysis of the recurring revenue, you'll note that this has also increased year on year from 85% to 91% of the total revenue. And again, this reflects the focus in the pension business in the UK market, with the differential between the two being largely related to exit fees in Malta, as well as a number of other income and commission items in the UK business. But steady revenues that deliver recurring annual fees with limited one-offs is a good reflection of the business growth from a perspective of delivering year-on-year steady revenue streams. Moving on to more divisional review, I've already talked quite a lot about the growth in the pensions revenue, 8% of the total revenue year-on-year growth, and again here very solid recurring revenue. Steady business from Curops, as Alan already mentioned, a good predictable revenue stream. And again, as mentioned, notable increases in auto enrolment, up 49% year on year, and a doubling of the group personal pension plan.
For me, it's interesting to look at the auto enrolment, because given the profile of auto enrolment, and it's just worth reflecting on what's happened in the industry really the last 3 years. Prior to authorization, I think there were 93 master trusts that played in the playground. Post authorization, I think that went down to 37, 38. Some then subsequently dropped out. Some have been acquired. Some have merged. For instance, we absorbed a couple of within our master trust. So you're down to, I think, about 27, 28 master trusts. So it's, in terms of the number of players, it's shrinking. In terms of the market size, it's growing. And if you look at the profile as to why is it growing, if someone works for an employer and then moves, their pension becomes preserved. It stays with the same master trust, and we still receive our £1.50 a month per member. That employer will obviously then recruit someone to replace that person, and again, we'll then basically get a £1.50 per month from those members. So there is, at this point in time, in terms of the curve of how this marketplace operates, almost a 6-7% organic growth built into the market. And you start to see then the challenge, I guess, as the marketplace becomes more mature, is how you pick up that additional employers. And that's where I think things like the niche products with the Wahed Invest, who are basically our partner for the corporate pensions in the Muslim community, is something that where you can carve out a difference. Where I think the market will get to is over a 10-15 year period. They'll end up fairly similar to the Australian market, which is probably 15 years ahead of us, possibly more, which is basically $1 trillion industry, we're dominated by 5 or 6 massive players. And that's not necessarily our end game, but it shows the ability, the growth factor there. And you only have to look at really what we've managed to achieve in the space of 3 years as to where that revenue's gone, on a sort of annual increase from 2019-20 into 21. And there's no reason to expect that wouldn't continue into 2022.
I won't dwell too much on the next slide, given that we've covered a lot of this already. However, this slide, which shows customer numbers and attrition rates, further highlights the stability of the business in that attrition rates are broadly constant and most notably a significant increase in the number of corporate members, which have increased from 182,000 to nearly 250,000, a 35% increase year on year.
And that's the opportunity, the challenge is how do you get that 70 to 80,000 fairly easy growth through to 170, 180,000, which is not, as a market percentage, is minute, but clearly adding another 100,000 members on would significantly change the profitability of that business, which is now profitable. It's gone through that hockey stick part of the curve, but obviously now it's about how quickly can we accelerate that growth, given that, roughly speaking, the fixed costs, the platform remain the same. So that's again why you see the likes of other workplace pensions, Spark pensions backed by JP Morgan, Legal and General. They've all invested very, very significantly in this because they see that hockey stick. And that's our challenge going into 22-23 in terms of that growth. Life assurance, I think that's back to me. Sorry, Nicole.
No, go for it, Alan.
Life assurance for me is the frustrating one. We've got a number of different products that should be selling more. That there's no doubt that there is a niche for these things, and we've got to be careful we don't just try and compete with the likes of the RL 360s of this world, etc., because we would become a poor second. It's about offering our portfolio bonds, our flexible annuities, which is an alternative to a SIP for someone who's coming up to the age of 75, in terms of what that profile looks like from a tax perspective, whether they're drawn down or not. These are the products that we know have got interest from various different IFAs, but it is taking a lot longer to really convert that pipeline. There's quite good visibility in the pipeline, but frustratingly, it's taking a longer time to convert. What we have seen really in the last 3 to 4 months is where we are talking with our strategic partners, and I've mentioned Head Invest previously. They have a demand on their platform to have a portfolio bond. We are their partner in the SIP business. We are their partner in the corporate pensions business, and therefore by default we have become their partner in for the offshore portfolio bonds. Again, a very straightforward, well understood and recognised portfolio bond for basically tax deferral. So it's the next stage really is for us to be able to exploit those strategic partners and really leverage on those. They have the distribution that we don't have. There's other partners in terms of where we again work with IFS is a good example, a small platform. They use us now for their SIP business. We get a steady monthly inflow of SIPs from them, but also they would like to use our flexible annuity. They would like to use our portfolio bond. And the key being that we don't have to invest heavily in the business development side of things. The key is that we provide a service that attaches to their platform and to their distribution network.
I think a further highlight in respect to the life assurance business is the fact that there are obviously these two entities which in essence offer the same offering, and so there is further scope to optimize our regulatory capital by looking at the configuration of these two businesses. And in fact, some benefit has already been delivered, but I think there is scope to take that a little bit further, and that is something that we continue to look at.
Yeah, thank you. That's a good point. And in terms of just, again, the life assurance side of things, given the type of products we provide, the portfolio bonds, etc., it's got a similar type of profile in terms of longevity, in terms of attrition rates, etc. Moving on to acquisitions, so I spoke about that briefly as a strategic pillar. Very much that we will continue to look for acquisitions. The parameters, as I set out roughly in terms of what we're looking for within that slide. It's an interesting market at the moment. I think we've accepted that we're not going to see quality books of Durops business at sensible prices. I think also as part of our strategy to have more of a UK focus, then any acquisitions, we will be looking more at the UK market. The workplace pensions market has become difficult to acquire things. I think there's a number of reasonably large players out there that have a lot to deliver in the next 2 to 3 years. And interestingly, it would appear that the multiple people are looking to pay for a workplace pension portfolio is 3 or 4 times revenue, which possibly gives you a reasonably good idea of what we think currently our workplace pension business is worth, given the numbers that Nicole's spoken about previously. So coming back to our acquisitions rather than anyone else's, our focus will be very much on the SIP and SaaS business. The key here is about ensuring that each business that we look at, and we see a number of information memorandums on a quarterly basis, is that it's got the right quality in terms of the investments in terms of standard, non-standard, split, etc., and whether the business was through UK advised or was introduced from non-regulated introducers. But there are some good books of business out there. It would appear that we're starting to partner more with some of the larger players who don't necessarily see their SIP business as part of their strategy. And I'm confident that we will be going back to the market soon with announcements about what we've achieved in terms of acquisitions.
I think just jumping in on that as well, the move to the 2 core IT platforms gives us the ability to lift some of these books that Alan referenced and into our environment in a much more seamless manner than maybe we have done in the past. So again, in terms of acquisition strategy, bringing some of those books on board is relatively straightforward.
Yeah, good point, thank you. I think it's worth mentioning, as I earlier on, Gerry Adams' case, because that has got some pretty significant implications to the pension industry generally, and actually, in my view, much wider in terms of financial services generally, or anyone that potentially is introducing business into a FCA regulated entity. A bit of background on Gerry Adams. Mr. Adams basically came to us through an introducer. That was an unregulated introducer. Mr. Adams made the decision to transfer his pension out and to invest in an asset called Store First. The asset exists. Arguably, it was overvalued. That's not really the point of certainly my comments, etc. And the case was around what are the responsibilities of the SIP provider. Should we have allowed Mr. Adams to invest into Store First? Should we have stopped him? Should we have commented on any advice he got? Clearly, there's arguments as to whether we actually have the right permissions to do that. And that's gone through basically a number of courts. And final, in terms of the case, that was won by Gerry, which is now called Options, primarily at the High Court. That was then appealed by Mr. Adams on 3 points. One was, and I'm no lawyer, so apologies for my sort of synopsis of it. One was basically Gerry didn't do their duty as a SIP provider. They didn't necessarily do the due diligence on the investment. They didn't act in the interests of the customer, all to do with basically COBS, conduct of business, section 3.2 from memory, and basically said that the SIP provider didn't do the right thing on behalf of Mr. Adams. That was thrown out by the Court of Appeal, and Mr. Adams didn't win on that point. The second point that he was appealed was that actually Gerry were in cohort with these introducers. They're almost one and the same, and therefore Gerry were culpable. Again, the courts found no indication of that at all. The third point is a really interesting one, and this comes into the hub of it. was Mr. Adams, or his lawyers, I should say, said that because he was introduced by an unregulated introducer, because that unregulated introducer encouraged him to invest in this investment, and therefore he made the decision to move his pension out, that actually that became regulated advice by an unregulated introducer. So it wasn't actually about the investment in the end of the day. This was about the advice that he purportedly received to transfer his pension out. What does that mean? It means under Section 27 of FESMA is that contract with Gerry becomes unenforceable. And therefore, basically, Mr. Adams needs to be put back into the position he was before. That's pretty fundamental. So actually, some of the really important points on this was that SIP providers actually can rely on contractual law. They can rely on doing what they need to do in terms of ensuring that the investment is suitable. Clearly, they can't advise a client because they don't have those permissions. But what it also said was actually, if you are, as a regulated introducer, so a regulated provider, dealing with unregulated introducers, and that could be as simple as an estate agent, which is quite a scary point or thought process for me, or a garage that sells cars and uses finance leasing. If you are dealing with an unregulated introducer, there is a potential that contract becomes unenforceable. Gerry lost on the basis that it was believed that prior to May 2012, Gerry had become aware that the introducer was carrying on certain activities that they shouldn't have carried on. In this particular case, Gerry stopped dealing with the introducer. We asked Mr. Adams whether he still wanted to proceed. He said yes, but it was deemed that there was no protection under Section 28 against Section 27. Right, so I'm sorry, I've probably bored everyone with the detail. What does this mean for us as a group? We've always stated when we acquired Gerry business back in 2019 that a very, very significant focus of our due diligence was around the PI cover and the sustainability of that PI cover to perform should there be claims. We were already aware of the Gerry Adams case at that point in time. We've, on a number of occasions, gone into the market and said we do not believe there is any financial implications for us in terms of the Gerry Adams case, and more importantly, anyone else that has those fact-specific scenarios around that Gerry Adams case. Because that's the bigger issue that the auditors had, is how do they try and quantify what this case means? Who has exactly the same fact-specific scenario as Mr. Adams? Because that's potentially that exposure, which is where this grossing up of this 21.4 million came from as the final number. And you'll see it's on both sides of the balance sheet. So from our point of view, actually there is no, we feel very comfortable that there is no P&L impact as a result of the Gerry Adams case. So hopefully I hope that puts that to bed. Obviously happy to take any further questions later on that, or more importantly, I'll get someone who fully understands the legal side of it rather than Alan's version of it. So where do we get to in terms of now moving forward? Nicole's closed the door in 2021. Welcome to 2022, Nicole. I think we've got a lot to do in 2022. We've got huge amounts of opportunities, but we've got to pick them carefully. There's business opportunities, again, on our international side, on our UK side. We need to ensure that those strategic partners that we have currently, we work with, we really benefit to the full extent that we can do. And that's the bit I felt we missed in 2021. We've got products that should be on the shelf already with them that aren't. As I said previously, I think we'll see acquisitions coming through, or at least a acquisition coming through in 2022, typically in the UK SIP and SaaS space. ensuring clearly that they meet that criteria we need for that SIP and SAS book. Looking at really the focus on margins, and that is going to be absolutely key. We are conscious that our margins are less than our peers. I see that as the opportunity. I see that we've got the IT platform now for the personal pensions into one platform. Now it's about exploiting that and delivering efficiencies on that. Because if we get systems development in one area, then we can use that both in the UK, Malta and Gibraltar. So there's no doubt we've got a lot to do in 2022, but certainly the opportunities are out there and up for grabs. And I think that certainly the management team is up for that challenge. Unless there's anything else, Nicole, you want to add, or Tom, nothing from you?
Okay, no, so all right.
Then I'd just like to thank everyone for listening.
Yep. Okay.
As Tom said previously, anyone that wants to fire any questions, then we'll come back to those.
Exactly. Okay, so thank you, Alan. Thank you, Nicole. If we could turn to the questions, we had a couple of questions that were submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Additionally, your feedback is important to the company, so immediately after the presentation, you will be redirected for the opportunity to provide feedback. While you're submitting questions, let's just have a look at a couple of the advanced questions. And in fact, we have addressed much of those in the introductory section. But maybe, Alan, you could just supplement the Gerry Adams piece by just giving us your thoughts on what this means for the wider pensions industry.
Yeah, that's a good question. For me, I think there's two elements of the personal pension market. One is very much the platform SIPs, platform personal pensions. The other area is the bespoke personal pensions. It's fair to say that as STM, our focus is on the more bespoke areas that can take commercial property, etc. I don't think there's any point of us having a strategy to go head to head with a Hargreaves Lansdown or an AJ Bell. We come a very, very poor second. So we have to focus sort of in that area. And I think there's a number of different players in that market. And I think they've all got their own challenges around what type of investments that they've taken in previously. And let's remember that the Gerry Adams was basically a 2012 investment. So all of these type of esoteric, these investments, whether they're just bad investments, whether there are unfortunately frauds, because there is no doubt that there are some of those investments were quite clearly, in hindsight, a fraudulent attempt to extract money from people. And I think that the SIP industry, in terms of that bespoke area, has to be very nervous about the implications to certainly Section 27. And it does go wider than that. I think, using my example, as I see it, estate agents, garage sale, new car sales, etc., etc. So I think I would expect that there's going to be companies, SIP businesses out there that just don't have the level of cover that Gerry was fortunate enough to have. The only reason Gerry had the cover it's got is because it was part of an international law firm that did some very large international transactions. And it just happened that the Gerry pension business sat within that group policy. And that is one of the reasons that we did pursue the acquisition. So I think there are going to be other businesses that will go into administration and liquidation. I think the challenge I think that some of these claims management companies have is to try and link the same fact pattern to what was specifically the Gerry case, and that will be, I think, part of any defence strategy. I think there's also the area around FOS and how a FOS challenging some of this. FOS are required to look at whether the outcome is fair and reasonable, but they are required to take into account legislation and legal precedents. And if they depart from legal precedents, and the Kerry precedent that Kerry did win was about, COBS 3.2 and acting correctly, that's quite a powerful thing that FOS, I don't think, have actually explained why they ever try and depart from that what is now a legal precedent. So I think there's going to be more challenges coming through against some of these rulings. But I think the SIP industry, particularly the smaller SIPs with lower levels of PI, are probably in a fairly uncomfortable position as we speak. Hopefully that.
Okay. Yeah, no, that certainly adds a little bit of colour. Great. Okay, so I'm just turning to some of the other questions. Simon, just a quick comment. You've got a number of questions in there that are quite technical. So we will actually review those post the presentation. It will probably be better for us to address those in writing, which we'll then publish in the Q&A. If I could just address possibly one of these, which is in and around the provision. In relation to Kerry pensions, STM Group has previously stated that there is existing significant PI cover that will pay these liabilities. In light of the recent news that a similar SIP provider, Rowan Moore Personal Pensions, has made a provision for compensation of 72 million, do we understand from this morning's release of the final results that Kerry compensation is only expected to be 21.4? Maybe we can just add a little bit of detail around that just in this particular case.
Yep. You want me to take that one, Alan? To start, and then you
can
jump
in?
in?
I'll chip in.
So quite rightly, looking at this in a lot of detail is what has caused the significant delay to sign off and finalising our accounts, both in respect of providing our auditors with support for that provision, but equally in coordinating with our insurance providers and other professional advisors to determine what we feel the correct level of provisioning is. So I suppose I start by saying provisioning is an area of judgment and estimate, and is based on the best available information at the point in time, and that is really the basis for the provision that we've raised. In consultation with our professional advisors and looking at the cohort that have characteristics similar to that of Gerry Adams, we have looked at the total cohort and derived the provision of 21.4 million, which is has a corresponding recovery in terms of our PI cover. I think it is worth noting that in respect of total provisions on the balance sheet, 24.1 million, there are a number of others that are referenced, which I note a couple of questions have been asked about. And again, those are fully covered by our PI insurance with an offsetting receivable from insurers on our balance sheet.
Yeah, just to add to that, I think the reality in terms of the provision is it's based on our best estimate at this point in time. There's no doubt that 21.4 will be materially wrong. It might be higher, it might be lower, but we'll only know this, I think, in the next 3 to 4 years. What we do feel comfortable with, and what we know the auditors are comfortable with, is that there is a matching recovery from our PI insurers. So I hope that sort of covers it. The 21.4 represents exactly what Nicole says, the exactly same profile of cohort as Mr. Adams.
Great. Okay, that's very helpful. I think the important point is that it's matched off by the PI cover on the other side of the balance sheet. So, quick question around the share price. With the share price having been stuck over the last few years at around 30p, has management considered share buybacks?
I think that's a really good question. It's something that we discuss at PLC level on occasion. There has been a focus on acquisitions. I think it's fair to say that with the credit line we've got currently, which, if we acquire another business will almost certainly be more or less used up, then the next phase is that we should be looking at some form of buyback strategy. you know, and I think it's a balance between buying back shares and growing the business. And I think it's fair to say that PLC have focused on basically the acquisition strategy and getting to that next level of critical mass. But I think it's an absolutely fair question, and it's something that I will certainly be bringing up again.
Okay, super. All right, well, we've got one other question which relates to that, which is the market cap of STM is currently less than the cash on its balance sheet, 17 million. You plan to go on an acquisition spree, but surely a large proportion of that cash has to be held to satisfy regulatory requirements. So how much cash is realistically available for acquisitions?
It's a fair point, and on page 17 of the presentation deck, there is some information about our regulatory requirements. Our total regulatory requirement is around 16.9 million. Given our cash balance is around 18, there is a little bit of headroom in that. However, we also have a bank line with RBS and a credit facility under that bank line, which is specifically dedicated to acquisitions. So we have currently in the region of 4.5 million available on that credit line.
Okay, super. All right. Well, that takes us to a neat closing point. So, Alan, would you like just to summarise for the investors a little 30 seconds on what you hope?
I think I've only got 30 seconds before it shuts off, doesn't it? Yeah. I mean, you know, from my point of view, I am a significant shareholder. I'm massively disappointed that we aren't at least more favourable to our investors. There's no doubt, if you look at the component parts of our business, that we are undervalued, in my opinion. So I think there are opportunities for new investors to come in. We do have the products and the ability to deliver and really upscale our profitability. You know, and I fully accept that it's up to management now to absolutely deliver that. You know, and there's no doubt over the last couple of years we've had investment, but it's been frustrating that it's been at the cost of profit. PLC recognises that needs to change, and the focus needs to be on the top line.
Great. Okay, that's super. Thank you, Alan. Thank you, Nicole. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide feedback. If anyone has any further questions or would like additional information on STM, please do get in contact via stm@walbrookpr.com, and we look forward to updating you again soon. Many thanks.
Thank you, everyone.
Thank you.